Hello, everyone. This is Elisa Baum, Director of Product Marketing for GridGain. We'll begin in just a moment, but first I'd like to conduct housekeeping. Could you please raise your hand using the hand icon located in the GoToWebinar control panel to let me know if you can hear me? Okay, great. Thank you. Appreciate that. Next, during this webinar, you will be on mute, and should you have any questions during the discussion, please enter them in the questions field within the control panel. At the end of the presentation, we'll take time to answer as many questions as possible. In addition, I'll make sure that everyone has a recording of this webinar and the presentation slides within the next 48 hours. With that said, I'd like to thank you for attending today's webinar, Driving High-Frequency Trading with In-Memory Computing, and it's being presented by GridGain Director of Business Development, Eric Karpman. And with that said, I will turn the floor over to Eric. Go ahead, Eric.
Thank you very much, Alyssa, and again, happy birthday to you.
Oh, thank you.
It's your birthday today. So thank you, everybody, for joining me today. This is an exciting topic for me, as I've spent many years dealing with high-frequency trading and various quantitative trading strategies for a number of larger investment banks and larger asset management firms. So this topic is dear to me, and I believe that in-memory computing and the products that GridGain brings to the market are the most suitable to this industry, to this segment of the financial services, specifically high-frequency trading. And hopefully within this hour, I'll convince you that this is so by explaining what high-frequency does, what type of technologies are traditionally used in high-frequency trading, and how in-memory computing can help further bringing profits within this market segment. So let's jump right into this. What is high-frequency trading? Why it's so popular? What type of strategies are being used? We'll talk a little bit about the business side of it, and then I'll talk about technologies that are normally utilized within trading desks, proprietary trading, algorithmic trading, high-frequency trading desks of different financial institutions, and what those advantages and disadvantages of using those technologies are, and then we'll move into in-memory computing. So high-frequency trading can be defined simply as trading securities in the financial markets multiple times at high speed in a fraction of a second with a certain strategy behind the scenes. So there are rules, there are engines that are analyzing the situation in the market and making decision on whether now is the right time to buy, sell, or do some other activities with financial information. High-frequency trading has been very popular, I would say, since around 2008-2009 timeframe, when we saw market instability, market volatility, financial crisis. Those are normally the good times, believe it or not, for high-frequency trading. When everything else fails, that's when those strategies really pick up. Because, like I said, most money can be made with the movements of prices. If the prices move fast and you're able to get to that to the information on the market fast and make execution fast, and you'll make a great deal of money because of that volatility that exists in the market. And that's why in 2008, 2009, those strategies were so popular, and specifically Goldman Sachs, for example, made a lot of money on the high-frequency trading desk. Let's talk about what the features of high-frequency tradings are. Well, there are three main features of high-frequency trading. First of all, it's speed, right? We need to we need the fastest speed possible of getting information. We need the best speed possible, fastest speed possible of processing this information. We need the best speed possible of transferring this information and analyzing this information, and we need the best speed possible for executing trades. So all of this speed race is what brings the most wins to the traders and making them more profitable than the rest of the market. That's basically what we're discussing here. And also, the last point on this on the slide, the transaction cost analysis and backtesting, is really important. It's not so much speed of getting information, processing information, executing orders, but it's really fine-tuning the algorithms, fine-tuning your strategies. It is really becomes a key feature here, where you are analyzing based on the real-time data from the market of how well your algorithms performed in this high-frequency trading fashion, and whether you should have improved it or should have done something differently. This is your chance after the fact to actually make improvements to those algorithms. As you can imagine, the top three bullets, when we deal with top three bullets, we deal with mainly transactional speed, right? Market data being received, market data being processed, and orders being put together and orders sent out for execution. All of this is transactional, heavy transactional processes. The last one is primarily heavily analytical process, right? It's not transactional, it's analytical. OLTP versus OLAP, right? So in high frequency trading, I believe the both paradigms, the OLTP and OLAP, really work together to bring you the most profits into the market. Let's now talk a little bit about HFT strategies. So again, we are a little bit better equipped with knowing what's involved and what type of analytics and what type of transactional speed comes into play here. So mainly high-frequency trading is based on quantitative trading, in which all portfolio exchange decisions are carried out by computerized quantitative models. And the idea here is really to predict the market's movements. And depending on your level of predictions, you'll be, if your technology is fast enough, you're able to take advantage of the predictions happening in the market. Here I identified 7 different strategies that are probably most prevalent in high-frequency trading. The first one is market making. Market making strategies bet on both sides by placing limits on a sell order at a little bit above the current market price, and also on a buy order slightly below the current market price. And then it works within those limits. We call it the bid-ask spread, where basically the wider the spread, the more profit is being made. In the world of high-frequency trading, computers are used to quickly identify and act on those advantageous spreads and trying to come up with a new concept of setting the spreads better than the rest, right? Because if you are going into buying or selling any security, there are normally lots of market makers acting in those securities, right? So, and obviously you are probably, if you're a rational investor, a rational purchaser or seller of securities, you are going to find the most advantageous price for you. How do you do that? Well, you look at the spread, right? You look at the spread and you see whichever bid is the best, or whichever ask is the best, you're going to go with that. And that bid or ask is determined by a spread. So how thin, how narrow that spread is going to be is going to determine whether your bid or your ask is going to be the most successful. So you need to analyze how other market makers are pricing the securities on the market in which you operate, as well as on any of the other electronic markets where those market makers are making markets for those securities. So you need to analyze a lot of data. You need to analyze the volatility of this instrument. You need to analyze how the price of the instrument that you're that you're making markets for is depending on other markets, and observing other markets, you can make a determination of what your spreads should be like. And again, like I said, if you are if your spreads are better than the others, then you're going to win most of the execution flow, and that's going to bring most of the profit to you. So that's market making, as you can imagine. It also involves a great deal of speed, analyzing the markets, analyzing competitors' positioning, analyzing dependency of your price of the security to the other prices of other instruments in the market, and then acting quickly onto setting up your spread. So great deal of transactional speed and analytical speed. Then we have this market taker approach, where basically you have nowadays in most of the markets, in most of the liquid markets, you have a situation with liquidity rebates, where the traders get either pay a fee to the market or taking a rebate from the market based on what they're doing, whether they're adding liquidity or they're taking liquidity, depending on which side of the transaction they're playing in. So again, by analyzing the rebates and setting up a strategy accordingly, a firm can find some arbitrage opportunities, some ways of benefiting from, let's say, buying on one market and selling in another market of the same security, knowing that, let's say, in this market you are being provided a rebate, and in that market you are not being charged a fee. So you do have a little bit of a difference in prices that you can benefit from. So that's normally what we refer to in the market taker strategies of HFT. Number 3 is arbitrage. Arbitrage is, as the word says, basically finding where the inefficiencies are within different markets, and taking advantage of that. The strategy heavily exploits latency, idea of latency, which is basically the time that passes between the electronic sending of a signal and the receipt of such a signal. Right, so you're sending something out to the exchange, and then exchange receiving this order, and then the exchange fulfilling the order. That, if you are faster than others, then you can take, and you can see in a very fast fashion any inefficiencies in the market, and you're fast in responding to it, and you're fast in placing your order. Again, this brings huge advantage to your profits normally. But because there are more and more players playing in this market, there are fewer pure arbitrage opportunities, and you need to create your algorithms smarter and more complex in order to extract profitability from market inefficiencies. Because if it's simple enough, then there are a lot of other players are also watching the market and also can find this inefficiency very quickly. And by the time you send your order, it may be too late. Again, speed and analytics are really hand-in-hand together here, and can bring up great results. The next strategy I wanted to mention here is pair trading. And pair trading is a trading strategy of pairing a long position stock with a short position of stock within the same economic sector, basically, or the same industry. Right, so I know I want to see. Well, let's say I'm dealing with Delta Airlines and United Airlines. I know they're both airlines. I know that their cost structure, or their expenses are somewhat similar. Price of oil and airport fees and other things that are somewhat similar between these different companies, and I can see historically that their stock is trading more or less similarly, depending on how the oil, where the oil price is, depending on the economic prosperity, or depending on weather, or depending on some other factors that are involved, and then I can deduce that this is more or less the normal trajectory of how a signal, this stock of Delta is trading versus the stock of the United Airlines, for example. And now, if I see that, for example, there's the difference between those normal trajectories is too big, then I know that, well, it's probably going to be a temporary thing, unless I see some significant news in the market. If I don't see those, then I'll probably decide that something is abnormal going on here, and I want to take advantage of it because I know this inefficiency is probably not going to last long, and I wanted to maybe buy one or sell the other to take advantage of that discrepancy in the market movements. Sometimes pairs trading is also used to pair a derivative with an underlying asset, right? Because derivatives are traded on one exchange and underlying assets are traded on a different exchange. For example, options on an options exchange versus an equities on the equities exchange, or some futures or instruments, whatever. You usually have certain derivatives and certain underlying assets, and you again know how historically they move. And when one goes up, the price of one goes up, the price of another goes down, and you know exactly what that ratio is. And again, if you're seeing that in different markets you have a discrepancy or different arbitrage opportunities, then you can act upon it and take advantage of that imbalance. There's yet another third form of arbitrage. We call it statistical arbitrage, which is much more complex, which you're actually looking at short-term related securities, and you are making determinations of what is really happening, in the short term versus the long term, and what the volatility is like, and trying to come up with a short-term strategy to extract value from knowing how different securities historically trade versus how they trade in the short spectrum of time. This is very advanced mathematical strategies are usually utilized in this stat arb business, and again, that requires a great combination of transactional performance, transactional speed, as well as analytical speed, because you are analyzing quite a lot as you are observing markets. So you need to observe market quickly, and you need to make decisions quickly. Again, both OLAP and OLTP types of approaches are extremely useful here. Next one is momentum trading. Momentum trading is a strategy used to stimulate the market by placing a number of trades and orders for a certain security in a particular direction. Usually in less than a second, these orders are canceled, and this action triggers competing traders' computers to react to this market information by buying or selling, and that creates an artificial price to change the market, and you can act against this. So, in certain markets, it's a questionable practice that critics are saying that those traders should pay for these activities because it's erroneous information that is being sent to the market. But this strategy still survives and still quite used on the street. Again, what that means is the access to information quickly and transactions processing very quickly is what makes this strategy successful if you have such an infrastructure to engage in this. There is another strategy called pinging, which is also quite controversial. It involves placing of small orders, such as one lot, 100 shares, in order to expose large hidden orders that exist on the exchange. Exchanges have traditionally hidden orders, either discretionary orders, hidden orders, iceberg orders. Different exchanges will call them differently, but you don't know. Those orders are not normally visible to you, and the only reason to find out if there are any hidden orders sitting on a particular security is to send some small orders and seeing what happens and the prices that come out of this. And so that's called pinging. And again, if you're, this strategy requires a great deal of analytics because you are sending small orders, you are making decision based on what happens. You have to, act very quickly. It's called like liquidity detection techniques are being used, and again, heavy analytics normally what's being used here. Um, and finally, within high-frequency trading, we also talk about news and sentiment trading. This is quite recent phenomena and becomes very, very popular on Wall Street nowadays, where basically you know historically that based on certain news coming out about a company or about a sector or about a country or about industry or about economic indicators of some sort, based on those news, market immediately reacts, and certain industries or certain companies are more more susceptible to changes in those news or events that are coming out from the market. And again, you're building your strategy in such a way that you are monitoring the news, monitoring what's happening. There are feeds that are available from large market data providers like Bloomberg, Reuters, and others that help you to interpret the markets and the news from the market in a certain way that can digitally feed the algorithms, and then a decision is made of what to buy or what to sell immediately based on the context of the news and the sentiment that this news is going to cause in the market. Right, so that's becoming very, very big area. Lots of analytical power because you have to understand the semantics. You have to understand the sentiment of the news story. You have to analyze how historically price of securities changed based on that type of news, that type of sentiment, and then make decisions and act upon it very quickly, because again, you want to be the first to act on the news before everybody else, which is going to change your price. Right? So again, very, very heavy analytical capabilities all up, as well as quite good, quite fast transactional processing power, or LTP. Now let's talk a little bit about technology that's traditionally being used in high-frequency trading to utilize those strategies to bring about what we've discussed prior to now. So again, in order for you to be faster, you have to have very good, very strong, very fast infrastructure. So some kind of dark fiber cabling to be very fast, to connect your decision engine with right next to the backbone of the exchange, the matching engine of the exchange, so you can, as soon as you detect the data, you can make a decision on it and send the order very quickly to that matching engine of the exchange. Collocation is obviously, you want to, the closer you want to be, the better it's going to be, the results you're going to get. So obviously, if you are putting your decision-making logic right on the same server, right on the same data center where your exchange is hosting the matching engine of the exchange, again, you're going to enjoy the most rates of profitability here. You're going to be closest to the liquidity, closest to the source of information, closest to the processing engine of the orders that you're going to be sending out. The other area that's becoming quite popular is FPGA and GPUs, right? field FPGAs, field programmable gate arrays, and GPU is graphical processing units. Basically, this technology is hardware-based technology that you pre-program your decision logic onto boards, onto hardware boards, and you allow the hardware to make decisions versus the software. Obviously, it's somewhat more expensive technology than traditionally the software, but also can give you hundreds of times faster response time and faster performance because you're doing most of the processing on the hardware. HFT, I would say, is probably one of the first adopters in the financial services industry of this hardware-based processing technology. Also, if you're dealing with a lot of data, right, because you are, especially if you're doing transaction cost analysis or historical analysis of the data for momentum trading, for transaction cost analysis that I mentioned earlier, for improvements in the performance of your algorithms, you probably deal with a lot of data and you need a way of expediting access to this data. So Hadoop is one of those techniques with MapReduce data structures and data algorithms are used to expedite access to data and processing of historical data. There is also this technology called CEP, complex event processing, which takes multiple streams of data coming in at the same time and using advanced mathematical data structures and algorithms, trying to come up with basically a formula or a way of analyzing this data and coming up with a result of whether to, whether now it makes sense to buy, to sell, and if to buy, by how many shares, if to sell, what to sell, how to sell, when to sell. So all of the, basically the CEP is configured in such a way that those decisions are being sought out from this algorithm, and so you have a lot of income data streams, and then you have those outgoing decisions that will feed the order management system or feed the engine that's going to then generate orders and send them out directly to the exchange for execution. There's also, people have also used parallel processing clusters where, to expedite, especially when we're dealing with heavy analytics, you need to expedite the processing of the data and analyzing this data. And one server is usually difficult to, is not performing adequately for that type of heavy analytics. So companies and firms have tried to use a number of different nodes into the cluster so that whatever they're doing, whatever they're calculating, can be run on multiple nodes at the same time to expedite the results, the processing of this data. And then finally, in-memory computing. Next is this is I believe, one of the newest area and one of the most successful one, because if you think about it, a lot of historical innovations in technology that I've talked about here, like hardware, calculations using FPGAs and GPUs, data acceleration using Hadoop and MapReduce, complex event processing where multiple streams are analyzed at the same time, parallel processing clusters where multiple computers are put together in a grid type of an approach, and in parallel a lot of data can be processed and analyzed at the same time. All of those concepts can be found within this in-memory computing. So what is in-memory computing? Well, we are moving from disk to 100% in-memory processing. Right? Absolutely, this is going to significantly improve our performance. Right? The results that we see is we get 100 to 300 to 500 times faster response times utilizing this technology versus traditional disk approach. and especially big data, a lot of time you need to analyze deep levels of data, level 1, level 2 market data. Absolutely, this is going to make it much faster, and we're able to produce results that we're looking for. Plus, we're also utilizing that clustered memory approach and parallel distributed processing approach that I mentioned earlier that's used quite often within high frequency trading today. But we build all of that distributed processing and clustered processing on memory, which results in a much faster performance, even comparing to those data-based, software-based parallel processing. Here I list a couple of different use cases where traditionally we were able to provide greatest results. And as you can see, my top category there is trading platforms with high volume transactions, ultra low latency, algorithmic trading. Basically, all the things that we're talking about today is probably one of our main use cases where our largest clients, some of the larger banks that I list here on this page, some of the hedge funds, some of the financial technology firms are using specifically for that to process lots of data and do heavy analytics on the data. Right. The other thing areas here: big data analytics, risk management, financial analytics. All of this is related to what we're talking about today, because, as I said, high frequency trading requires you to a great deal of analytical power to analyze a lot of data and making decisions, as well as compliance. Whenever you are trading something, you also have to have certain compliance checks done. And again, if you do them in memory, absolutely you're going to be more advantageous than other players in the market who are still using software-based checks for their compliance controls. Here I list one of our use cases, as Bearbank is the largest bank in Russia and the third largest in Europe. And we were able to help them to improve significantly performance, where they've actually analyzed a number of different vendors in the space, in the in-memory computing space, and they chose GridGain because of greatest performance results. We were able to generate 1 billion transactions per second, and all of this on only 10 Dell blades with 1 terabyte of memory, which cost the bank about $25,000. As you can see, the cost is significantly reduced versus the older days when people would wanted to in in-memory for high-frequency trading and algo trading, but always the argument was made that it's too expensive and it's not worth the millions of dollars that need to be spent on something like this. Well, here's a good example where less than $30,000 can help you to process so much data and be so much faster, that I think this argument is not valid anymore. This is an article from a CEO of Bearbank that basically says similar to what I just said, that they liked our platform because of excellent performance, reliability, because it's cheaper, and because it's so much advanced on the technological level and provides a great deal of machine learning and analytical capabilities that they just couldn't find from any of the other vendors that they've looked at. There's another use case here from Silver Spring Networks, where basically in-memory processing is being used to add scalability, to do the analytics of different level using open source technology, and scalability especially great here, even though it's not financial services. But I think it shows that there are different industries, people that need to analyze data people that need to transact quickly throughout their enterprise are enjoying the power of GridGain. Newegg is similarly, it's an online consumer electronics store, and again, they've shown also, they've seen best performance possible using our technology, as well as in-memory analytics that was coming up here. Why now? I mean, I think it's a great time. The cost of memory had been significantly reduced, and because of that, we are able to afford now this technology that we couldn't before, and it solves a lot of problems. It solves transactional problems, it solves analytical problems, it solves data consistency issues, it solves reliability issues, it solves scalability issues. Basically, most of the problems that we're dealing with in today's financial area, financial services problems can be resolved using RAM and the price that have been significantly dropped, especially for those applications where significant data usage is observed. Well, we also happy that GridGain was named a gold vendor for in-memory computing. Gartner noticed us. Lots of analysts are mentioning us in different press releases. I mean, we are very happy that practically everybody that gives us a chance, that does a proof of concept with us or looks at our technology, chooses our technology. So GridGain Enterprise is our main product, and it's fully based on Apache Ignite. It's a full open source technology that's intended to provide easy way of accessing data, and basically there are lots of contributors to this project, and it's been tested out globally. It's one of the most popular Apache projects today. But obviously open source is great to play with, to be vendor agnostic and independent, but at the same time there are certain features that open source does not provide for enterprise class companies, and that's where GridGain comes in, where it helps to solve some of those problems. Specifically in in-memory data fabric use cases, we are able to provide not just a data grid, but also high-performance computing that's required for high-frequency trading, machine learning, risk analysis, grid computing, scalability, real-time analytics, big data, fault tolerance, and advanced clustering mechanisms to, again, bring about faster speed while not sacrificing high availability and rebalancing and performance issues, and the messaging and complex. You see, within events, there's a complex event processing. We also utilize similar technologies of multi-streaming and analyzing this data and making decisions of what to do with it, as well as some of the advanced data structures that we also support that help, again, in performance and orderly conduct of in-memory components. We also quite flexible in terms of the APIs that we support. We support Java, .NET, C++, SQL. If you're already using Hadoop and MapReduce, we fully support that, and we can improve significantly basically the performance of various Hadoop implementations. So as I said, the main benefits of in-memory data fabric and in-memory computing that we bring to the market are, obviously high throughput, low latency, load balancing, in-memory indexing. All of those performance improvements that will be required to successfully run high-frequency trading or algorithmic trading strategies. Scalability, as the data grows, we may need to scale because we need more data to analyze, to get better predictions, to get better analytics out of the system. So again, GridGain is great in terms of scalability and adding cluster nodes and in a pretty economical fashion. We also pay a great deal of attention to high availability because we understand we're dealing with financial institutions where basically it's required to have certain replication, failover, fault tolerance, quick recovery, and all of this has to be available to larger enterprises, and that's the strength of our product. As some of the largest banks in the world, when they analyzed us, they said, "Wow, you guys are better than a lot of other competitors, or most of the competitors that we've seen from the high availability perspective." Then we're fully transaction processing reliable company where we fully deal with data streaming, multiple formats, optimizing data, and basically, so it's fast and consistent transactions processing. It's what we bring to the market. Persistence, we can work within the in-memory only, or we can go onto the disk as well, and then create a tiered approach where some of the data, most frequently accessed and analyzed data, is going to sit within the memory, and maybe something less frequently analyzed is going to sit on the disk, and we can decide how to hash that data between different tiers within storage and memory. And then obviously security is a big deal for financial services companies, so we are fully embracing all the required encryption levels, tracing, auditing, basically anything that financial services require to have as a fully functional financial enterprise system. On this slide, I just summarized basically what the Apache Ignite is, all this, the grids and streaming and some of the technology behind the Apache Ignite. Obviously, GridGain fully supports because GridGain is the initial author of the Apache Ignite. So absolutely, it knows better than anybody else how Apache Ignite works and how to further improve areas where improvements is needed, and that's where you get into the GridGain Enterprise, where we actually provide some additional functionality which is not currently in Ignite, like additional security, data center replication, enterprise level support, and the viewing and auditing mechanisms. All of that is provided as additional services by GridGain within the enterprise license. We also been validated by a number of analysts, and as I mentioned on one of the previous slides, Gartner has taken great interest in us, and Forrester, and many other industry analysts are looking into us and saying that GridGain is one of the primary companies behind in-memory computing today. So if you feel that in-memory computing is the right strategy for you, if you feel that high-frequency trading that you're running in-house, or algorithmic trading, or quantitative trading for that matter, and you're looking for ways to improve your strategies to beat some of the competition, I believe that GridGain is the primary product that you should look at, and contact GridGain, ask somebody to do proof of concept, ask them to get you a box and do the testing of those strategies, and we can show you that the results will be quite pleasant for you for relatively low entry point and spend on the product. So that's basically what the message I wanted to bring to you, and hopefully I was able to convince you at least to take a look at the product and we'll be more than happy to work with you to explain further, to provide you some of the references of companies that are using us and seeing greatest results. So that's all I had for today. Please do ask me any questions you want, and I'll be happy to answer them.
Okay, audience, you can, if you have any questions for Eric, you can go ahead and enter them in the questions section of the GoToWebinar control panel. At the moment, there are no questions. You did a really thorough job, Eric. We'll give it
Thank you.
a minute for people to type things in.
Mhm.
Sometimes there's a small delay.
Yeah, and I'd like it to be an open-ended discussion, maybe not just questions, but comments and some ideas, because I'd like to hear them. And, if you don't have them, then I'll be happy to maybe follow up with you later on with some of my ideas and to establish, an ongoing relationship and communications.
Right, and also just wanted to remind everyone that I will send both the slides and a link to the recording sometime in the next 24 to 48 hours. I have to process the recording. Okay, well, Eric, I don't think there's any questions. So again, you must have done a very thorough job, audience, and thank you so much for your participation and your attendance. Eric, thank you for another great show. And with that said, everyone have a wonderful afternoon or morning, depending on where you're calling in from. Thanks again,
Thank
Eric.
you very much. Thanks. Happy birthday. Enjoy.
Thank you.
And I'll speak with you tomorrow. Thank you.
Okay, bye-bye.